Peace, family, Grand Rising. How's everybody doing out there? I already know what time it is. Bitcoin Block Bully coming to you once again with an early rising crypto update. And we are going to be covering digital crypto dollars and the yields that they can bring. And I'm going to be using a article that comes from the DYDX blog post or blog page to further explain what we're going to be speaking on today. What I'm going to do is allow the chat to open up. Also, let me do this. Let me go ahead and actually grab this and share it. Since for some reason it's not allowing me to go live on Facebook. So what I think I'm gonna do is just share the YouTube channel on Facebook. That way individuals can tune in. Like I said, for some reason it's not allowing me to tune in. Let's see. Let me get the link real quick. And this will, for the most part, I'm just recording a podcast, so I'm just going to be doing mostly reading and commentary. Not a lot of interaction as usual. Not as much interaction as usual. Let me see. Let me get this share real quick. Copy that. Cool. Slide this back over here to Facebook so I can post it. And then we're going to start reading within the next couple of minutes. Let me get this posted out. And fam, for those that are tuning in, if you can, please help and assist me in sharing this out. Please help and assist me in sharing this out. Let me see where those captures at. Okay, here we go. There we go. That's a lot better. Let me get rid of this one. Delete. There we go. All right. So I do have it shared out on Facebook now so people can tune in. Brother Michael, what's going on? Peace, power, and prosperity. Grand Rising. Grand Rising. How is everybody doing? How's everybody doing? I'm going to give it a couple minutes for the chat to fill in. Once again, family, if you can, please help assist me in sharing this out via YouTube, Facebook, Instagram. Let me get my podcast pulled up, ready to record. Okay, let's get that up and running. And let me go ahead and introduce myself. Peace, power, and prosperity, family. You already know what time it is. It's the Bitcoin Block Bully coming to you once again. The early rising crypto update. Today we're going to be talking about digital dollars, crypto dollars that can bring back, in my opinion, a better yield than the national fiat currencies or world fiat currencies that are utilized in each jurisdiction of government control. And what we're going to be allowing to lay the groundwork for today's discussion or today's overview is a blog article from DYDX, which is an exchange market, which is opening up and allowing for decentralized perpetual contracts to be traded on it. In the next coming weeks, I believe, that should be open. This article was released April 28th, 2020, and it's examining the world of crypto dollar yields. For those who don't know what a yield is, let's go ahead and get a simple explanation up. The definition of what a yield is. Now, yield in an investment standpoint is the income return on an investment, such as the interest or dividends received from holding a particular security. The yield is usually expressed as an annual percentage rate. So when we look at the for those that are more familiar with the space and can navigate through it, if you're familiar with loanscan.io, they do show an array of different yields or interest rates for a number of different digital stable currencies, which are pegged one to one to the United States dollar. For those that are actually able to see the visual right now, we're looking at USDC or United States dollar coin, DAI or multi collateral DAI, USDT, United States dollar tether, BUSD for Binance United States dollar, and USD for true US dollar. Um, and they have different yields ranging from, 8% to 7%. Kind of high today, actually. We're looking at the different percentages across the market: 3% on idle finance, 2.9% on Aave, 1% on Fulcrum, actually 3.69%. This is with DAI, and that's on the DYDX exchange. So we're gonna jump into this world real quick. Let me check. Let me make sure everything's coming through clear. For those that are listening in, please let me know if you can hear me. Please let me know if you can hear me. Coming through on the YouTube channel, as we are streaming live as well right now, as well as recording New Money Matrix podcast. So I want to give a salute to all those that are going to be listening in on this, as well as those that are going to be watching. Once again, family, if you can, please help assist me in sharing this out. Please help assist me in sharing this out. What I'm going to do is I will share this out one more time via Instagram. Let people know that we are currently live. Let people know that we are currently live. And then we're going to start off and begin with the article. Let me get this in here real quick. Disconnect there. There we go. There we go. There we go. And then we're going to start off and begin with the article. Okay. There we go. Okay. So let me go ahead and do that. And there we go. All right. So let me share this out. Let me share this out one time. And then we'll get started. Tech Money Tuesday, as I like to coin it. There we go. And we are out there. All right. So let me get this up one more time. Let me go ahead and reintroduce myself. Anyone that may be tuning in, let me make sure I get the thumbs up. Okay, they said they can hear. They said they can hear. So we're going to go ahead and get this started. Peace, power, and prosperity, family. How we doing out there? It's the Bitcoin Block Bully coming to you once again with an early rise and crypto update. As of right now, we are streaming live via YouTube, recording New Money Matrix podcast for those that are going to be listening in on Anchor, Spotify, iTunes, among a number of other different streaming networks. I want to give everybody a grand rise and a salute. How's everybody doing? I hope your day is filled with joy. It is going on 6:44 a.m. right now, Chicago time. It is actually May 12th, 2020, as we begin the second quarter or Q2 of the year in the crypto space. What we're going to be speaking on today are digital crypto dollars and the amount of yield that you're able to bring back from those. And once again, we're going to be using a DYDX blog article to discuss these different types of dollars. Again, this was released April 28th, 2020, and we will be examining the world of crypto dollar yields. The article goes on to state, the ability to earn dollar yields that are multiples higher than what most investors can earn in the traditional finance system has been and will continue to be one of the largest drivers of new demand for cryptocurrency. These yields are a function of both demand for dollars in the crypto economy, as well as the difficulty associated with getting fiat into the ecosystem. The most widely and used financial services that produce dollar yields are exchanges, centralized lenders, open finance lending protocols, automated market maker models, and crypto derivatives. Each of these venues and unique is unique. Um, they vary based on a number of different factors, including liquidity, counterparty risk, custodianship, and of course, potential returns. One aspect many of these platforms share is that they are powered by crypto dollars. Let me get this out of here. There we go. Crypto dollars come in many shapes and sizes, which this post will dive into later. But the general premise is that it's a digital asset which pegs its value to the dollar. The most novel aspect about these crypto dollars is their programmability. They can be sent anywhere in the world and can be seamlessly integrated into any blockchain-based financial application. An interesting parable is to think of crypto dollars as Venmo dollars that were set free, finally able to be used within other financial applications. Most notable aspect of crypto dollar yielding opportunities up to today has invariably been how much greater they are than traditional counterparts. As an example, the United States 1 year Treasury note yielded 2.57% in 2019, while lending United States dollar coin on the DYDX yielded 4.86% APR over the same time frame. This premium is a function of the fact that crypto markets have historically been bullish. But even more importantly, they reflect how hard it is to actually get dollars into the ecosystem. Investors in need of dollar financing know how quickly crypto prices can move. So they have been more than willing to pay a premium to get quicker liquidity. In the early days, the only way to borrow or lend dollars within the crypto confines was through Bitfinex's margin order book. Yields fluctuated massively as it was difficult for crypto exchanges to secure banking partnerships. Lack of banking made it very difficult to force supply to enter the marketplace. So there wasn't much of a neutralizing force when demand suddenly increased. In order to solve their banking issues, Bitfinex created Tether in 2014. With Tether, the dollar representations could be sent within the crypto ecosystem. Investors could use it to trade against cryptocurrencies. And those without access to traditional banking could actually hold Tether to get exposure to the dollar. I'm gonna stop there and I'm gonna say that this is interesting for individuals that may be in a economy or geographical location, demographic location, where their own native national fiat currency may be failing. In parts of the world such as Venezuela, Argentina, um, Zimbabwe, who at one time had $1 trillion note, if I'm not mistaken. So you being able to gain exposure to the United States dollar without actually having to hold the physical fiat is quite a feat. It goes on to state, in 2017, the market capitalization of Tether ballooned by 1,400% as it became obvious that on-chain dollars were far more effective than having to deal with the traditional system. From then on, stablecoin took hold. In terms of growth, stablecoins have been by and large the fastest growing crypto assets since the start of 2018. Right before many of them launched, over the course of roughly the last 2 years, the market capitalization of the highest market cap assets fell anywhere between 46% and 83%, whereas the market capitalization of all stablecoins increased by 464%. A lot of this growth can be attributed to the fact that many new lending markets were built around these stablecoins in 2018, which enabled them to be lent at a high interest rate. High interest rates create a huge incentive to convert traditional dollars into crypto dollars, as evidenced by the market capitalization growth of USDC, DAI, PAX, and GUSD or Gemini United States dollars, the primary stable coins with lending markets at the time. On a macro level, interest rates conditions in the traditional system have drastically reduced the opportunity cost associated with holding dollars in a regular bank account. There's not much interest being lost. There's not much interest being lost by turning dollars into crypto dollars. Since the start of 2018, the 10-year Treasury yield fell from 2.40% to 0.73%, a 70% decline in savings potential. That's just in the United States. In European countries like Germany, the UK, and France, 10-year notes yield negative 0.36%, negative 0.36%, 0.30%, and 0.09% respectively. The world has never been this desperate for a yield. Crypto dollar yields aren't completely immune from a low interest rate. Following the market decline on March 12th, lending rates for USDC fell over 80% on the month, from 4% APR all the way down to 0.45%. Luckily, rather than react directly to central bank policy, crypto dollar yields are primarily a function of market sentiment. If crypto markets can remain uncorrelated to traditional markets, there's a good chance crypto dollar yields will continue to be much higher than anything offered in the traditional world. Apart from basic stablecoin lending, there are a number of more complex financial instruments that enable crypto dollar yields. With more complex financial instruments comes the opportunity of higher gains, but of course, with higher risk. In this post, we look at the most widely used avenues in the crypto ecosystem through which users earn dollar yields, the trade-offs and risk associated with each venue, as well as the potential returns. Let me just check and make sure that everything's coming through clearly. Peace, power, and prosperity to everyone that is tuning in right now, listening in on the New Money Matrix podcast, on the YouTube channel, and may later listen in on the New Money Matrix podcast. Continuing on, we get into the exchanges. Speculation has been far and away the most in-demand use case for nearly the entirety of crypto's existence. And as such, exchanges have been the biggest beneficiaries of the ecosystem's explosive growth. As exchanges look for ways to expand their businesses and find revenue streams less correlated to volatility, it quickly became obvious that the winning business model was to build a vertically integrated crypto bank. They already owned the user relationship and the assets. The next step was to offer them a full suite of financial services. After all, crypto is all about new forms of money. Hence, the term that I've coined, the new money matrix. Naturally, extending users the ability to earn interest on their assets is a low lift for exchanges. Users by and large choose to hold their assets on platform, and exchanges already have the demand side necessary to facilitate borrowing. The most common interest earning opportunities available on exchanges are margin funding pools, where users lend their assets to speculative traders, or interest accounts, where the exchange guarantees the user a certain yield and then has the freedom to try and lend those assets out for a higher rate. The former is just like margin funding in the traditional world, and the latter is more like a security deposit or CD. What we're looking at now are a couple different exchanges, what they're offering and the supported assets, and then the different yields that they offer. As we can see, Coinbase has an interest account for USDC, and they offer 1.25%. Not bad. Binance has margin funding and interest accounts for Binance United States dollar and USDT, and they offer anywhere between 6.46 and 6.12% respectively. Lending through an exchange is arguably the most simple way to earn interest on crypto dollars. Since users aren't required to do anything more than send funds to their addresses, the experience is very akin to traditional banking, something most users are familiar with. Liquidity for margin funding accounts is typically high, albeit there could be instances in which all consumers' deposits are being utilized. On the other hand, There we go. On the other hand, interest accounts usually entail a lockup for a certain period of time. In terms of counterparty risk, exchanges are large central points of failure as they have ultimately custody of user funds. Remember, they have the custody. Custodianship is a big thing in this space, which is why I tend to opt out for DeFi, and I'm pretty sure they'll get into that a little later. Users lending through exchanges should be cognizant of potential attack vectors and practice diversifying their lending activities away from one exchange, meaning don't put all your eggs in one basket. There are also new exchange models, of which DYDX is one, in which the actual exchange never takes custody of the user's funds while they're being lent. That is key. From an overall risk perspective, exchange lending is relatively low, which leads to a lower potential return profile. However, many times the lending yields offered on exchange markets or on exchanges are much higher than any consumer savings account, making them worthy alternatives for the risk taken. And into institutional and retail lenders, trade markets have been one of the fastest growing parts of the cryptocurrency industry, particularly fueled by the rise of institutions and retail lenders. These firms aggregate capital by guaranteeing an interest rate to depositors and then lend those funds out to institutional investors or retail individuals. The largest firms include Genesis Capital, BlockFi. Where is that Genesis Capital? They've got it separated by no, it's not. Okay, I thought it was separated. So Genesis Capital, BlockFi, and Babel Finance. The primary difference between these lenders is what type of investor makes up their deposit base, institutional or retail. As we can see in the example below, they do have Genesis Capital, whose deposit base is institutions, the borrower base is institutions, and their originations is 4.3 billion. We get down to BlockFi, you have institutions and retail on both the deposit and the borrower side, and they have about 500 million. And then we got Babel Finance, who's similar to BlockFi with their institution and retail. And they're coming in at about 380. The type of lending activity really took off in 2018 as institutional investors looked for more efficient ways of short selling cryptocurrency. In the latter 2 quarters of 2018 alone, Genesis Capital was able to originate over 1 billion in crypto loans from institutional investors. 2019 brought with it a bull market, which spawned the advent of cash lending. These lenders saw explosive demand for crypto-backed cash loans and the ability to offer retail investors yield on their dollars. Based on the figures included in Genesis's Q4 2019 report, as well various industry reports, we estimate that over 5 billion USD have been originated by institutional and retail lenders, 40% of which is cash loans. These centralized lenders are extremely liquid given they were designed to serve institutional capital. Most lending agreements are open term, meaning the borrower and lender have some flexibility on capital lockups. Returns are generally higher than lending through an exchange, and custom terms can be negotiated for large dollar sizes. The main downside is counterparty risk, custody of funds. In these arguments, the lending firm takes full custody of lent funds and then transfers ownership to the borrower. In the case of a default, the lender is trusting the lending firm to cover losses. Let's get into the lending protocol. Lending protocols are a net new financial innovation, uniquely enabled by crypto rails. These platforms allow users to borrow and lend money directly from a smart contract without having to give up custody of their funds to a centralized third party, a stark contrast to today's most dominant centralized model. Now, this is the thing. This is a peer-to-contract type of relationship you have when you're dealing with this decentralized finance space, i.e. lending protocol. So it's not peer-to-peer, it's peer-to-contract, P is P2C. Whereas you are able to hold custody of your funds. meaning that you have 100% responsibility over those funds as well. One of the main things you have to stay up on, as this ever is an ever evolving market, is you have to stay ahead of the developments and the changes that may come to the platforms that you use. You may open yourself up for significant loss due to ignoring the comings and goings of some of these platforms, such as upgrades. So always stay up on top of whatever platforms you use. Continuing on, it says the key to these protocols is that they're built on top of virtual machines that autonomously handle all parts of the loan administration process. From origination to liquidation, a centralized entity doesn't need to be involved. The most widely used lending protocols are MakerDAO, Compound, and DYDX. Maker is unique in that interest rates are ultimately set by MKR holders via the network's governance process, whereas rates in Compound and DYDX are set in real time by the market. Similarly, Maker's DI savings rate can never be higher than the stability fee, whereas Compound and DYDX often offer rates higher than the stability fee because the protocol can be more quickly adjusted to speculative demand. And below we have different protocols: DYDX, MakerDAO, and the compound finance money market. The interest rate method on DYDX and compound on market with Maker risk governance. DYDX has 1.2 billion in originations. Maker has 600 million, compound 316 million. DeFi lending protocols are still relatively new, so it's naturally going to take some time until they're as liquid as their centralized counterparts. Two big factors that will help these protocols increase liquidity are security best practices and time. The former will help expose and innovate on weaknesses inherent to these protocols, which is the practice, and the latter will help reinforce the safety of those protocols, assuming they remain secure, which is the time. An area where lending protocols excel is custody, since users are always in control of their funds. There is less risk of a theft relative to a centralized exchange. Returns vary based on where the capital is being lent, and lending on more speculative venues that enable more leverage, like DYDX, offer higher returns because more notional value can be borrowed. Automated money market models, or AMM systems, enable anyone to play the role of market maker by allowing them to pull two-sided liquidity that traders can tap into. In exchange for the liquidity, suppliers earn a yield. Within crypto specifically, AMMs have been used as a solution to the liquidity issue faced by decentralized exchanges that employ basic maker-taker systems. AMMs make it much easier to bootstrap markets since anyone in the world can act like a market maker. Two notable AMM projects opening up dollar yields to investors are Uniswap and Balancer. Uniswap was the first AMM system to gain real traction, which it did by opening up liquidity for DeFi assets that were not widely supported on centralized exchanges like MKR, Maker, and SNX, Synthetics Network Token. Balancer extended the Uniswap concept further by enabling pools with more than two assets. In both of these models, liquidity providers earn yield by collecting trading fees generated by each pool. Like DeFi lending protocols, AMMs are still extremely new, so liquidity isn't strong. For context, the ETH to DAI and ETH to USDC Uniswap pool only have 6.7 million and 4.9 million in liquidity, respectively. Counterparty risk is low from a self-custody perspective, but high from an experimental technology perspective. You got to understand, those that are in this space right now, you are the pioneers, aka guinea pigs of this space. You got to eat that up coming into this. You know what I'm saying? Understand that these things have not been battle tested over an amount of 10, 20 years. We are the first ones to touch a number of these different protocols, which has its pros and it has its cons. You know, continuing on, it goes on to state that many times No, excuse me. Returns offered by AMM models are different from basic asset lending. Many times, supplying liquidity to these pools in search of a yield is akin to a short volatility position, so investors can actually lose money during times of turbulence. There are also instances in which growth in the size of the pool mitigates the effect the volatility has on potential returns. Overall, returns provided by AMM models are higher but riskier. For a deeper overview, they do have another link, which I may follow and I may read over at a later date. Let's get into derivatives. When most people think of cryptocurrency derivatives, they think of purely speculative use cases, when in fact, cryptocurrency derivatives offer clever solutions for earning dollar yields. An important aspect of these derivatives is the fact that they're managed and settled in the base currency. So, in the case of crypto BTC and ETH, both quoted against USD, this means that short positions effectively lock in the dollar value of the notional position because even if the price increases, the value of the collateral back in the position also goes up. Not only do these short positions act as synthetic dollars, they can also earn a yield if the market pays a premium to hold these derivative contracts. If users are short through a perpetual swap, they are paid interest every funding window. If they are short through a traditional futures contract, they collect the annualized forward premium over the duration they have the position open. Interest earned is very much correlated with how bullish the market is. In 2017, there were many times in which BitMEX's XBT USD contract was paying over 1% interest per day. More recently, this number has come down, likely in part because of most traders entering synthetic USD positions. In the last year, XBT USD paid out over 8% in synthetic dollar interest. 8%, not bad. Synthetic dollars are created through futures contracts, with perpetual swaps being the most liquid way of doing so. Futures are by far the most liquid way to get exposure to crypto. They facilitate billions in trading volume daily. Compared to other lending options, synthetic dollars are very liquid. However, a big downside is that synthetic dollars can't leave the exchange. Positions have to be held until expiry. This means that users still bear a lot of crypto counterparty risk. Excuse me. Centralized exchanges are much more susceptible to hacks and thefts. Luckily for synthetic dollar holders, the added risk does come with a higher reward. During times of high contango, yields often spike above 20% APR. I bear witness to this myself. In conclusion, one of the most powerful use cases enabled by cryptocurrencies today is the ability to earn dollar denominated yield. Already, the crypto financial services ecosystem has birthed a variety of dollar yield sources, including centralized exchanges, institutional and retail lenders, decentralized lending protocols, automated market makers, and synthetic dollars through derivatives exchanges. With all of these options, users have optionality across a number of features like liquidity, custody, risk, and potential return. As you can see, there are clear trade-offs for investors chasing the highest potential return. Lower liquidity is the main trade-off for decentralized finance platforms, and counterparty risk is the main trade-off for derivatives. Crypto dollar yields will continue to pull people away from traditional world. As these offerings mature, so will the ability to onboard more capital into the crypto world. Um, at DYDX, they're excited about the future of crypto dollar yields and the role that they play in providing non-custodial liquid on-ramps to dollar yields. Similarly, they pride themselves on being the only venue that allows users to both lend their crypto dollars to a decentralized protocol, as well as access synthetic dollars through their perpetual market. So, as a introduction, I guess you could say, to crypto dollar yields, for those that may have been listening in for the first time, I do hope that this article, as well as any added commentary that I did add, was helpful. to the viewer. Um, what we're going to do now is end the podcast series and leave it open on YouTube for any type of questions. For those that'll be tuning in on the New Money Matrix podcast, I want to thank you for coming in, tuning in, and listening in. I hope once again that the information was helpful to you. Until the next podcast, peace, power, and prosperity, family. I'm out. Okay, so we have ended the podcast, but we are still live via YouTube. Are there any questions or comments for anyone that is out tuning in right now before we end this? Are there any questions or comments for anybody out there tuning in? And we'll give it a minute to see if we got any questions that are coming in. While we do that, let's go take a look at price action, see exactly what's going on with Bitcoin. And let's take a look and see what's going on. Which I'm gonna be doing I'm actually gonna be doing a podcast on Hex a little bit later, and just reading through um their homepage, just try to get an understanding. This is Hex still holding nice gains, very nice gains, while the rest of the market is doing what it does. This one is uncorrelated, as we can see, highly uncorrelated. As we come over here and we look at these charts, now actually bouncing off of the 236 here at 86.52. Looking to come back up and retest 10,001. We do have a nice trend trend line to the downside and maybe opening more candlesticks below it. Let's open this up real quick, see if we got any yet. Okay, so we see where we've come down, bounce, come down, bounce, broke out, come right it again. Line is holding. This trend line is holding for now. Hold on, let me get this podcast out. There we go. I did want to get this out here real quick. There we go. Say, and for those that want to listen to now, publish. Which lending platforms do you like using best for coin? Compound finance, to DAP, um, mainly compound or anything that allows for the compound API to be utilized or the compound open source code to be utilized. Any other questions coming in from the family? Any other questions coming in from the family? Nice. We do got support coming back in from the 21-day exponential on the daily. We got going on the weekly. We are above all major moving averages. 4 hour, you do have overhead resistance actually being dragged down by the 21 and the 55. Also, you do have a bearish crossover on the 4 hour, where you do have the 21 crossing over the 55 to the downside. Coming into play as support, you do have the 100-day exponential moving average, which is the purple line here, 55 and 21 being the orange and the red lines here located. So we'll be looking for support to hold above that $8,500 area looking to actually break and start opening and closing, not just break, because you can see we've broken here but weren't able to open and close. You got to get some type of opening and closing coming in above 89.50 in order for you to continue your upside move. Other than that, if you start opening and closing 4 hour candlesticks, I'm gonna say below this level of $8,500, you can definitely see yourself come back down to the low 8,000 and possibly even the $7,000 area. What should be done for the halving? Absolutely nothing. You don't have to do anything for the halving. The halving was actually yesterday, but you have to do absolutely nothing for the halving. The halving is coded in, so it takes place on its own. The only ones that are affected right now, majorly, are those that may be mining cryptocurrency. The amount of rewards that you were receiving yesterday just got cut in half. But as far as a holder, an investor, a trader, the halving has absolutely nothing to do with it. There's nothing that needs to be done or should be. Take a look at some alts here. Take a look at Link. Look at it versus the US dollar on Binance. Which Link, let me see, what do we got going on with Link? 4 hour, let's go back to a daily. Link looking a little toppy here at around 390. You definitely don't want to break $3. Possibly come back down to 240 if you break there. Possibly get a drop. If you break that $3 mark, probably come back down to around 240 on Link. XTZ Tezos. Right now you are getting rejected by the 21 on the daily. Not good. Could press you down, come back down, maybe retest 180. If you're not able to hold 225, right now you're at 254. In order to see extension, you want to get back above 290. Not even just get above. You want to open and close at least a 4 hour candlestick, at least a 4 hour candlestick above 295. I was about to ask about altcoins and how do we use them. I mean, that is a wide question. There's over 5,000 different currencies in this space. I think so. I think it will go down towards the end of the week and Saturday. I don't know what you're talking about. It'll go down, but I mean, they got a number of different functions, number of different use cases. Some of them have absolutely no use case. You know what I mean? It's all about doing your due diligence and figuring out exactly which coin serve which function. For instance, Synthetics Network Token. For those that do know, that's a proof of stake currency, which you're actually able to stake in a platform known as Minter, which allows you to mint synthetic United States dollars and gain a weekly interest or a return on the amount of state currencies in the form of SUSD, which is synthetic United States dollars, and SNX token, which is synthetics network token. Now, those rewards are escrow from 1 year from the time that you claim them. Then you have certain currencies like Chainlink, which Chainlink is an oracle, which allows for information to be fed to different platforms, such as price feed. Okay, I'll look at one of the coins. Also, for those that do post coins, please post one coin. Please try to post one coin specifically. It gets too cluttered up when everybody wants two, three, one, two, three. More than two or three coins per person is a little too much, and it's want to make sure everyone's satisfied. So one coin per person. What you want? OK Bull or Cardano, brother Michael? Well, OKB, OK Bull, or Cardano? Let me see. So, okay, so to get at me outside of YouTube. I guess if there's no more questions, family, I want to thank all those that did tune in for this early rising quick crypto update. I want to thank all of those that did tune in on this early rising quick crypto update. Make sure there's no questions or comments in closing before I end this. Okay, said either. Let's take a look at. I'm interested in OKB myself. Let's take a look at OKB. Well, I haven't looked at it in a while. Here we go. 196 coming down from a low of about almost $8. There we go. That gives us a way better view of it. Man, look at that massive spike. You had, a nice little correlation going here, and you had a massive move from about $3.50 up to $7, broke all the way back down to 236. Wow, this is one hell of a catch right here. March 11th, could have caught it around $2. Right now, you more than 100% return. Let's see. I wonder what we got rejected by over here. Let's take a look real quick. None other than the 618. So as you can see with OKB, swing high, swing low, fib retracement, 618 retracement, break back down, 50% support around 475. Right now you're at 497. So nice bounce off the 50% retracement line. As long as this holds, you can most likely see movement. We can see us push back up towards that $5 and set $37 mark. Look for a little bit of resistance coming in at around 513 on that trek higher. Once you're able to come up, crack, break, and start opening and closing levels above $5.60, then you can look for that extension at the crack of 580 back up to around $6.20. That is okay. And with that being said, I'm gonna go ahead and end this, family. I want to thank everybody that did tune in for this early rising show. Peace, power, and prosperity, family. I'm out of here.